Now next, let's look at the long and short put together, called the long-short strategies. Now the long-short strategy, you long one, you short one. So long-short basically is like a zero cost. So if this is zero cost, then how do we calculate the return? Let's talk about that. But before that, if you have a portfolio that you long and short asset, which they are almost perfectly correlated, then if you do that, then you pretty much create a risk-free or systematic risk-free portfolio. This we call market neutral strategy because there's no systematic risk. All right, so the beta is zero. If you have a complete risk, then the standard deviation also zero. So there's no volatility. So, for example, if you believe that a company is a IBM versus Intel, they're perfectly correlated in the same industry. So you long one, you long the IBM, you short the Intel. So what's your result? If they're moving together, you long one, short one, and really you have no return. Unless you believe they have a little bit different direction, meaning that if you long the IBM, when the IBM price increase a little bit more than the Intel, when they decrease, they will actually decrease less than the Intel, then you will have profit. So to do that one, the purpose is try to eliminate the expected systematic risk. Okay, so long short is a hedging strategy. That's the reason a lot of hedge fund, they call the name of hedge fund because they are involving long short position. Okay, long short position. Long short position base actually is not hedging. They're trying to take profit, all right, arbitrage profit from what? From the mispricing on either the long or short side or both. So it's an arbitrage process, not hedging. So I don't like hedge fund, the name. It is not hedging. They're doing arbitrage. They make money from arbitrage profit from long short. So you think about long short is a heavy leverage. Suppose you got $100. You don't need to use the $100 to buy stock. You short the stock at $100, and then you can buy another $100. You still keep the $100 cash on your pocket. All right. Or if you are a little bit greedy, so you can do what? You can just, all right, I got $100. I'm going to short $100 and put $100 I have to buy the $200 stocks. But anyhow, you got long and short. You're still involving a huge amount of risk because you have unlimited liability on the short side, right? Because we just talked about short had unlimited risk on the upside that will keep you down. So the liability is a huge amount. And the upside is what? Limited. If you got a long position, your upside is limited. So that means it's imbalanced. So in other words, the hedge fund is not risky. It's not riskless, right? Because it's very risky. Their risk and the upside and downside is asymmetric. Okay. So their residual risk, we talk about tracking risk, which is not applicable for long short position hedge fund because they don't track any benchmark, right? So it caused by the information risk. If they got a problem with the long short imbalance based on the wrong information on two different sides, so the market against them, they have a huge amount of residual risk. There is a case called LTCM, Long-Term Capital Management Company. The case that happened in 1997, Asian economic crisis. That is a huge amount of residual risk. A $200 billion fund fail, hedge fund fail. Okay. You may ask the question in the exam, say, well, if two asset long short are perfectly substitute, perfectly correlate. So if they're really perfectly correlated, right? $1 down, down $1, down $1. So what's the risk they are facing? The risk is not systematic risk. It's pretty much the noise trading risk, or noise trader risk, meaning that it could be the mispricing in the short term. Now, if the asset between long short they are not imperfect substitute, then they're going to face two risks. Not only in addition to the noise trader risk, but also involve the fundamental risk because they are not perfectly correlated. Right? There's some additional information will affect at least one side of your position, and then you caused by this fundamental risk. In other words, if it's not perfectly substitute, you still have these the systematic risk is not zero. That means the standard deviation is non-zero. Okay. If we only use the market neutral position, the long short, and the long short you can generate alpha, but you don't have any exposure to the general capital market. So when the market had a trend moves up, the long-term profit, you're not going to catch up. So sometimes a lot of managers say that, well, I need alpha, but also I want to enjoy some beta that's going to give me some systematic return in the long term. So how do I do? One way to do is that, well, you still keep your risk neutral based on long short to generate alpha, but at the same time use futures contract. So you can long or buy the futures index future. Why futures? Futures is cheap. You don't have to put a lot of money up front. So it doesn't cost you anything. All right, cost you anything. Because long short position you have there, it doesn't cost you anything, plus you got a lot of cash on hand. Why don't you use the cash at the same time as a collateral to actually long or hold the index future? Because index itself is a market index. For example, you can long the S&P 500 SPX future contract, then you still enjoy the general market pattern, but at the same time you have the market neutral position to generate alpha. This we call alpha beta separation. It's a very neat, very interesting method. All right. So long the large cap market index future to obtain the beta, and short the small cap growth to generate alpha. This is an alternative way to do. All right. So this week, usually when you see that kind of statement, that is alpha beta separation strategy. I put here is to summarize this alpha beta separation and the nature of itself, right, is to equalize the long short position. In other words, you make the long short become in like equity position in the market, so that still enjoy your the beta seeking character. So to have equity market beta exposure from the long short position through futures and ETF. Right. So this is a very popular strategy now in hedge fund industry, even in the like private equity firm or other type of the very active portfolio management. They use this method all the time, because that way they can earn a market return. So they have a market return as well as the alpha. Okay, so that way you get generate two return. So in summarize here, the total return is higher because you're going to have a gain and loss, the capital gain and loss from the long short. All right, and then also you can have a gain or loss, of course, loss from the futures. Now, in addition to that, think about if you got long and short. Right? If you get a long short, if you long something, you're going to have dividend, right? Suppose you short an asset which is less dividend payment, and then the long asset you can go to the ex-dividend day, enjoy to get a dividend, then you get additional income as a dividend on the equity. Now remember, you got $100 and $100 on hand. You can short $100 and buy another $100 asset. Never touch your cash $100. So you can put $100 into an account to earn interest. So there's a four income, possible income from this strategy is the long short, the gain from long short, the gain from futures, the gain from dividends, and the gain from interest. So that's very interesting. Now sometimes if you long and short and it sometimes costs you more money, can I combining the long short, all right, and the equalization, meaning I have beta in one, just in one allocation, one setup. How do we do that one? We call short extension strategy. Short extension strategy. This is called 120 versus 20 strategy, meaning that you don't short 100 versus 100. Suppose $100, you're going to do here, you short amount of $20, 20%, all right? You short 20%, $100, you short 20% of the market value of the loan portfolio, and then you buy $120 loan. In other words, you have a $120 loan because your net cash is $100, so you short 20, get a $20 and buy $120 asset. Right. So that is a little bit like hybrid semi. So you still have a long short position, but also you also have the equity position there to enjoy the beta and alpha. Now, another question usually in the exam is this 120 short extension strategy, is this the same with like a 100 long only strategy plus a 2020 strategy? Like you buy $100 stocks and then you short $20 and then buy another $20 stock. Is this the same? The answer is no, they are not. They're different. So you short 20 and then buy 120 is different than, buy the 100 and short 20 and buy 20. That's different. Okay. So make sure that you understand 120-20 is different than 100 plus 2020 strategy. Why? The reason is that the key differences is that the 2020 strategy, the portfolio decision on the long short are coordinated, where the combination of 110 and 2020 strategy, they are not coordinated. Right? They generally is not. Statistically, you can see that clearly, all right, because that related to the dependency or independency issue.